Well, a collar in itself is the purchase of a stock, and it needs to be a stock that you feel is going to go up, because that's the key, is it still needs to go up. But in order to protect the value of the stock, you buy a put option, and then to pay for the put option, you sell a call option. It's basically a way of buying a stock and buying protection on it and having another factor that will help pay for that protection. What we started finding is when people retired, they wanted to make some money, but they could not afford to lose large percentages. Well, if we take an example of a stock that sells for $100 a share, and we buy 100 shares of it, well, the first thing we want to do is protect the value from a catastrophic drop. Well, let's just say 10% is your risk factor, your risk tolerance. So I would buy a 90 put. What I've done is I've acquired the right to sell that stock for $90, no matter how low it goes, for a period of time. We try to stay with a 3-month expiration date between now, or the purchase date, and the expiration. No matter what happens, we have the right to sell it for $90. So if I bought it at 100 and the stock dropped to 85, I could just wait it out, and maybe it comes back, but if it doesn't, I can always get $90 a share. So the put acts a lot like an insurance policy with a deductible. There is a strategy called covered calls. In the example of we pay $100 for a stock, we may write a call at 110. So what that means is that I am receiving money, and I am giving the right to someone else to buy my stock for 110 a share, no matter how high it goes. The ideal scenario is where the premium you receive for writing the call equals the premium you have to pay to buy the put. We're selling away a little bit of the upside, and so that those two kind of are neutral cost, and we're looking to let the stock move up with protection. We did this with Apple. We started about 3 years ago, and I think it was $200. Well, we started sliding the collars up. Well, finally, the stock got to about $700. We had the 750 calls. We'd sold the 750 calls, and we had purchased the 650 puts. Well, that was the first time that Apple dropped significantly in value, and we ended up selling for $650. If we can keep you from losing, significant money, and we can consistently gain, that is a very good alternative to what else is out there these days. The best thing they like about it is it's the sleep factor. If I wake up and I see something terrible has happened in the market, I don't have to go look and see what happened to me. It's something that we do it well, and it's enjoyable, and the clients all seem to like it.